All right, we are going to start now. I know it's kind of last minute, but hopefully, we get some good questions here. And then, unfortunately, we didn't record the other ones that we've done before, but this one will be on YouTube just in case you guys want to go back. And, we're going to utilize the chat as well. So I explained this to you guys earlier, but, I want to say it for the video while I'm re recording it. And we're just going to, I'm going to give some thoughts right now. You guys can type out your questions if you want. I'll go through them, from first to last, and usually that takes a while. Try your best to ask something that everyone can benefit from, and then this should go on for probably an hour or so. And if you need to dip out, it's all good. It'll be uploaded eventually. So right now, I always kind of like to give like a state of the market idea to everybody, just so because not everybody knows exactly what's going on um, in the market, especially if you come in at different points in your journey. And I think that's something that's really helpful for others to hear, especially when you know you hear it from somebody that you look up to or respect and things like that. And it was also really helpful for me just to be like, hey, this guy is not really doing so hot, or this guy's killing it. What am I doing wrong? And these are kind of indicators that you can use in your journey to make sure that you're not like over punishing yourself, or not seeing things clearly, because at every stage in your journey, and this is all only going to apply to our small niche here, so it's not exactly everybody, but it is extremely helpful to know exactly kind of what the direction is, because as you know, uh, markets do cycle, and we haven't necessarily seen so much of that, let's say in 2020, but that has been more and more relevant, especially in the later half of 2021 when things have started to slow down. And I think for a lot of even intermediate traders, not even I was gonna say newer traders, but even just for intermediate traders, it is something that you'd want to be aware of, because you cannot always just force every market. You cannot just, because you're like, I think the mentality that I got trapped in early on was like, I want to learn. I'm going to put in as much time as possible. I'm going to just work my ass off. But no matter how hard you work, it has to be the correct market for you to actually, benefit from what you've learned, because you can completely, let's say, oversize into the wrong market, and all of a sudden you've blown up your opportunity to actually trade when you're set up to start to work, when things are more favorable for you. And as well as, you just want to be cognizant of the fact that you are on the market schedule. And no matter, with equities at least, we have 5 days a week, and you cannot really rush that aspect of trading, which is why it takes a pretty specific amount of time, in my opinion, no matter how much effort you put in to actually truly develop. And of course, there's a small amount of people who will catapult exponentially to the next level in their earlier years, but a lot of times those people are aided by like a very good support system, and more importantly, they have like very specific and important mentors in their life, and not everybody has this. So as with everything, I like to just make mention that as traders, you want to aim for what works for the average person, so that even if you attempt it, at the very least you'll have a good result, and if you do even just a little bit better, you're going to be above average. Whereas if you try to trade like very aggressively and very low margin for error, then only a handful of people can execute the strategy. So what's the point? And I remember, and I'm going on a real big tangent, but this is just how my mind works, is that um, there's a really good uh, teacher out there, and I don't want to share his name because he locked his account, so it's not even relevant. Like you can't even find it. But there was a guy, and he said, like, if you're teaching somebody, then their charts and their executions should look very similar to yours. Like, imagine all the times that you're learning from somebody, or that you see people learning from other people, and their chart looks exactly it doesn't look exactly the same. It looks completely different, and they have wildly different results. I mean, what is that, right? You cannot really pinpoint exactly what they're doing or why, and I think it's a real big problem. So one of the only people that I've actually taught, and I don't do this. His execution is basically the same as mine, and we traded the same stocks. We don't have to talk to each other, nothing like that. Same, very similar results. And the thing is, like, one thing that I also want to highlight about this is that it's been very interesting for me to kind of see the dynamic between that relationship over time, in the sense that there will be times where he's doing a little bit better, and times where he's doing much worse, and vice versa, where I'm doing better or much worse, but we're executing the same thing. And the difference where two people are trading very similarly is actually coming down to the psychology, which is why it's so important. And it's just something that I noticed that's really interesting. So as that develops, I'll probably elaborate on that more. But you know, you just have to make sure you're listening to the right people, because there's a lot of kind of nonsense going on lately, and the most evident aspect of that are the pump and dumpers who they have so much momentum in the prior weeks, and even prior months, and not really being punished. So you think you have some kind of edge, you think you have some kind of strategy, and at the end of the day, things like today happen where they buy this GRNQ, halts up, stuffs, never looks back, and it just fades all day long. And there's something to be said about that is a strategy, sure, but again, then in the right market environment, as you can see, a lot of these pumpers, they don't even know how to trade for real. Like they wake up in the morning, they're looking at pre-market, they're like, yeah, okay, what am I gonna pump today? And or they have positions the night before, and they're just like, okay, let's see what we can do. And when you're coming into a week where the last couple of days they've been getting hit by offerings, and actually interacting with the market the way it's actually meant to be, that's a huge reality check. Because I don't know what, but the underwriters and everything like that, they have been kind of sleeping on the fact that every single trash name is really running hundreds of percentages, or holding up all day long and not taking advantage of it. So like, you have a strategy during this, we can call it a bull market, because all these strategies are working out. But that's kind of counter to the nature of like small caps in general, and the fact that most of these companies are complete garbage. And even if they're not, they're usually trying to earn cash. They're trying to make cash and raise. So it's a interesting dynamic where you can have the right thesis but still be wrong, and that's where you want to think about the different dynamics of the market and where you're at. Like, what is the actual psychology? So kind of these pumpers, they're literally showing up today thinking that they have their whole army full force. Like, yo, it's like Napoleon going into Russia. Like, they're fighting into the snow, and their soldiers are dying every single day. They're being malnourished. Some of them got murdered on some of the last plays, and they think they have the full army today. And those dudes, they're not there. Their army's not there. They don't know how to trade without like all these sheep. And that's where you get these massive opportunities for short sellers to come in and actually interact with the market the way that it generally does work. So it's kind of interesting for me to see how weak these people are. And at the moment, basically, you want to use them as kind of like an indicator of, hey, are they pushing the market in a substantial way or not? And you can basically tell by the mass psychology of, like, let's just think about the last times they've traded, and let's think about if we can either take advantage of their momentum they produce, or the counter momentum, in the sense that they can't really fabricate moves. So that's something to really, you can basically rely on that right now. It wasn't always this way. It used to be more of like a smaller fish, but lately there's been so many people who are you don't even You got high school kids who eat Taco Bell 4 times a week who have like 30K followers on Twitter, and then they have like 30K followers in Discord, and like, it's kind of crazy they can actually move the market, but yeah, that's the way it is. So the problem is you manage the risk and you take losses, 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 and then on the backside there's not much for you there. And if you don't manage risk, yeah, you're gonna win a lot. And I mean, I've seen that there's a lot of people who, hey, I don't have no risk. I just add it to the top, whatever. But I mean, those dudes are going to take fat losses from time to time. And if you're the wrong person at the wrong time, thinking about the wrong person, and you're just so enamored by that style, then you can blow your account up before you even have a chance to walk, like to get off the ground. So very, very important to pay attention and try to be conscious of this. And like, I mean, the fact that basically most of you people in here have the exposure, it's really good. And I love to see like when newer traders mention that they found the feed, because like at the least I can do is kind of point them in the right direction, or look at their shift their awareness away from like what you normally see, because a lot of this stuff is pretty bullshit. I mean, you have to basically lie and kind of scam to get ahead, and those people benefit the most because it's the easiest to kind of understand what people want. They want a quick solution, and that's just not what trading is. And you will hear that echoed time and time and time again. And there was even a point where I didn't get in an argument, but I just mentioned, hey, like as traders, I think we should be tracking certain statistics, and it doesn't have to be hard statistics. So like myself, I'm not a hard statistician, but what I like to do is I like to keep a general idea. And you can, the thing is, numbers don't really lie, in the sense that if you track yourself, you're probably going to get a more accurate view of like what you're actually achieving, versus like if you just base it on your experience, because we have a kind of a negative slant in our bias. So we're going to remember a lot of the negative things that happen and not so much as the positive things. And even if we have an equal number of negative to positive, we have a cognitive bias where the negative impacts us basically 3 times or more than one positive thing happening. So what happens is, when you can break down the numbers, you can actually just look at like think basic things. What's my win rate? What is my average kind of gain on these trades? What's my average loss? And actually, by manipulating these statistics, you're able to create like a profitable system. And it has nothing to do actually with the strategy or anything like that, which is really peculiar. You'll see the interview that I posted with Tom Basso at Confessions of Market Maker. Same thing. This guy he's one of the best traders. He was managing over $600 million in hedge fund, and he had like a 30% win rate as well. And how can this be, right? It's because this is something that you'll just see all the time. And I just think it's really important for people to understand like the dynamic between your winners and your losers. That's it. And it's math. It's not something that even it should be argued. Like the fact that someone can say, "Oh, that's just nerd shit." That verbatim nerd shit. I was like, I don't understand, because it's not something I made up. It's not new. It's literally math. And if you just do the math yourself, you'll get the result. And the fact is, anybody can take the statistics, input that into their own, equity curve sim, and generate a positive expectancy for themselves, or at the very least understand that they're on the right track. Here's one thing. Occasionally, I'll talk with traders one-on-one, and I'll just say, hey, let me see your average win, your average loss, and your win rate, and then we'll plug it in. And lo and behold, look, if you trade this system perfectly 1,000 times, 10,000 trades, you will not be profitable, or you'll be barely profitable. So if you can actually kind of understand where you're headed before you actually take those steps, you can save yourself a lot of grief. And on the other side of that, you can kind of develop something for yourself where it does have a positive expectancy, and it's a really good one. So knowing humans, knowing that you're gonna fail, and this is what I was kind of talking with ADF today about on Twitter, building in failure, is that look, equity curve sim is gonna run like a completely perfect algorithm. we're not algorithm, we're humans, and we're going to make mistakes, we're going to fail, we're going to become emotional. And so when you can plot a curve that's like very good, then at the very least you're going to be somewhat average, or just happy, profitable. So that's the number one thing I think that people need to understand is just, let's look inward versus like, I need this perfect entry signal, I need this perfect exit signal. It's not actually really like that. It's mostly about just keeping that relationship between your average win and your average loss in line with your win rate. You can have a very, I used to say 3R, 3R, 3R. The reason why I say that, and I don't say it too much today because it is debated often, like, people will say, hey, look at this guy, look at this guy. And that's a fair point. It's average loss, average win, and win rate. You can have a very low average risk reward and a very high win rate. But the thing is, it has to be that way, because if you actually, do the math, then you'll see like that can be profitable only because of those conditions. If you have a very low risk reward and you have a very low win rate, you will not be profitable. I don't care what you say. And if your wins rely on you being riskless, in a sense that you have to, add to your losers infinitely, have no stops, basically vary your risk so much that it's completely out of control, or that it's completely emotional. That's a big problem, because trading professionally and having trading maturity is knowing exactly what you aim to achieve with each trade. You know exactly what I stand to lose, and you more or less know like what your average kind of return should be for these setups. And that's something that's really, really important. So, I always want to caution about that, but this is a long way away from the market environment. I just want to say, look, the follow through wasn't really there, and that works really well. Thing is, that doesn't matter, because if you just think about it this way, oh dang it, I lost. Uh, I'm probably addicted to the market. I want to learn. I want to do this. I'm just simulating the average person. I'm gonna refund my account Monday morning, Tuesday morning, and we're good to go. Or I will, work another week. I work another month. I put my paycheck in, because the market is straight up addicting. It is literally gambling, and you see those people in Vegas. They're just hitting the slots all day. You will literally never come out ahead in that situation. But why do they do it? It's just that rush, the money. I don't know what is that addictive factor of gambling, but as a professional trader, your mindset needs to be so far removed from gambling that you're not here to, just guess what's going to happen. You actually need to create a system and a positive expectancy from the get-go, and that's always going to come from journaling and checking your stats. And it doesn't have to be very difficult or complicated. Actually, you can just save all your charts, look back on them, say, hey, look, how many times is this working lately? You can factor in the big picture. So you have, let's say you have a couple months of charts, and you can say, over the last couple months, there seems to be some sort of edge here. And then you can also factor in, okay, in the past month or so, it has not really been working. But if you zoom out again, this whole year, let's say, oh, there's an edge. So you have to be able to see that, analyze the psychology of the market, and then not lose faith in yourself with a system that produces good results. And the main way, literally the main way, is just keep your losers small. So having the determination to calculate out your risk before you enter the trade, and your position sizing, that's probably the most, number one factor of why traders will either, fail or succeed, because within position sizing, you have so many ways to control how long you're staying in the game as a beginner, and you also have the ability to manage your bankroll as a bigger trader. And it's something that never leaves you. So if that's not something you're prioritizing now, it's very important that you start focusing on it today. And you can ask me, the main thing you want to do is you want to identify a level of risk. And usually the way to do that is you can say, hey, I have I have an account. Let's take like a percentage of that account. Granted that this account is money that you're, willing to lose. Like obviously if you took your whole life savings, you put in an account, risking 1% might be a little bit aggressive. In your trading account, ideally, this is money up for grabs. Anything in there is for the market's taking. Seriously, it's not yours. And so you take a percentage of whatever you're comfortable risking, and then that becomes your dollar risk. So let's say you have $100 risk, and you want to enter a trade short a dollar, and you say, okay, I'm going to risk 10 cents, $1.10, you have 10 cents risk. You do $100 divided by 10 cents, and I'll give you 1,000 shares, I think. I'm gonna double check right now. I'm pretty sure that's the case. And so what you can do is you can now go in with the confidence, hey, if I take this loss, I lose exactly what I mean to lose, and maybe a bit more with slippage, who knows. And the beauty of this also is because this formula is consistent, you can put this in your Excel, and you should all have an Excel just on the side while you're trading. And you just put the formula in there so it does the calculation for you. And that way you come to the trade knowing exactly what you're risking. You know exactly that it's not going to cripple your account. And you trade with a asymmetric bet so that if you are rewarded for the win, then that will recoup multiple losses, or that you'll win so much that you generate such a positive lead over your losses that you were profitable. And it's just the basics of it. And so, the thing is that's something that a lot of people like severely underrate, and it's the basis of any like systematic type of thinking in trading. And it shouldn't only be this way, but I think that not a lot of people want to talk about. So that's the only reason why I need to repeat it so often. All right, so let's go ahead and we have a ton of questions. I'll go through them here. I think someone mentioned, I know there was a question. Okay. Curious, when you stop on big sizes, just one order, or you have to break into small orders? So for a long time, you will not need to break your orders down. See, the thing is with scaling, people scaling a lot of times because they cannot physically interact with the market with their liquidity size. You can impact the market in a way where you push price against you unfavorably, both on the exit, i.e. slippage, or on the profit target, where you push the market up and it doesn't really recover, or you become a floor. And this is something that you're not going to have to worry about for a long time. Chances are, if you're asking this question, it is not going to affect you, because if it was affecting you, you would understand like why you need to scale. So it's something that I really recommend most people just not even really think about, because as you start implementing things like that, it overcomplicates the process to the point where you're like, oh, I have 1, 2, 3 exits. I have 1, 2, 3, 4, 5 entries. And the problem is now it's becoming harder and harder to calculate your risk, because as the market's evolving, there are more emotional triggers going on with the trades, where things go parabolic, things tank, and you're going to corrupt your average cost. You're going to corrupt your risk level. And if you trade so dynamically, it might be a problem in terms of managing risk. Now, if you're a really adept trader, you're an advanced trader, and you can get away with it, congrats. You're like Michael Jordan, you're like Kobe Bryant. You're like 1% of the top 1%. And that is something that takes time. Mastery of liquidity is something that you're not going to have to worry about for a long time, trust me. Especially in a market when they're trading millions of shares, hundreds of millions of shares in a day. But I will say, you need to have kind of a fail-safe for these times. So you can stop out like with your size, or you can break it down like 1 or 2, if liquidity is a factor. If you can basically always get out in one shot, I think it's a good thing. You always need to have some sort of extra hotkey, or be ready to pull an order that did not fill completely and to slam out, because like at some point slippage is basically always a given, and you're gonna have to be able to get out of that position so that you can reset. And the problem is what a lot of people think is that hey, if I just hold it all the way and it comes back down anyway, then I will win. I won't lose money. Thing is, the best thing you can do is actually manage the risk, because you will actually get a better entry price after resetting your risk. And if you reset basically all of your shares, then you don't have to worry about the previous entries pulling your average down. And the problem is, like, if you would go for that, where you just have this super wide risk and you don't cut it and it comes back down, the reward on that position is going to be so much less than if you had just cut the position, put it back on, taken it all the way. Not only that, but the risk of actually blowing your account up is there as well. So, it is something that you have to get over. It's something that, it's not exactly what you said. I'm just elaborating as I usually do, but it's really important that you actually, just stop out the whole thing. And if you get slipped, so be it. If the thing halts up in parabolic, just slam out. I don't care if it pulls back, because sometimes what happens if it doesn't? Then you're screwed. And it happens all the time. I'm sure plenty of shorts got completely destroyed in this market. Plenty. Because I know lots of really great traders who haven't really had that great of a time. And I, for one, I know, like, if I wasn't executing at the level that I am today, it would actually be pretty damn hard to not be red. So that's something to consider if you're managing risk. And, the problem is, like, if you're not if you're not like having your pulse on the market, then you basically give in to what's happening today versus what would work over the long term. And that will lead to certain changes that could be good. Like, I like to say, if there are outlier trades, and if it happens enough, and if those trades give you a really good reward on the backside, then it is worth it to kind of filter, or to adapt your setup or your strategy, your system, to those outlier trades, meaning, like, maybe a little bit later signal, or you give it more room, or whatever it may be. And those can have a positive benefit to you over the long run. But if it's like you have this system that's worked all year, and, like, for 2 weeks it doesn't work, and then you just change everything, it's really important that you can back up that using, like, Excel. I like using Google Sheets more. The difference is really subtle, but Google Sheets is uploaded online, and you can go back, which I really like. So I will often go back. Let's say, you can literally go back, or I can go back to January and see what I was doing. And so that way you don't lose progress, or you don't lose track of exactly what you were thinking and what you were doing. So you can go back and get on the right track if you ever deviate or make some kind of foolish mistake. But the worst thing you can do, really, in my opinion, is to, like, overcompensate, especially if you know, like, things are not exactly conducive for you. All right, let's see. Are you all searching for new strategies when you are? Is backtesting an essential part of the process for each new pattern? Will you ever trade patterns just because that's what kind of market cycle you need to backtest for them? So I like to look for strategies within my strategy. So, like, deviations. And you should know, like, I think more importantly, you should master one or two things, provided they give you enough opportunities. And I say it a lot, so I'm not going to go over it again here, just for the interest of time. But essentially, I am observing those deviations, and I'm thinking of how to use them, but I don't focus on it. So if there is an opportunity where I'm looking at the market and I'm seeing those deviations working, I have a basic idea of how to execute on them. And so I will try. I will say most of the time it doesn't work, but it's important to notice, because sometimes it will. You just have to recognize, like, what is exactly my bread and butter, and, like, really understand that exactly, so that you can always come back to what made you profitable. And a lot of times I will deviate, and I will just cut it off once I realize, like, hey, I'm just hemorrhaging money in this. And in terms of searching for new strategies, if your strategy doesn't happen very often, then yeah, you wanna be searching for strategies so you can at least take a trade a day. In my opinion, just that's just the way I am. I want to trade every day, as well as a lot of people probably don't notice, but in trader tax status, you have to trade some like 70% of the year. I'm not sure exactly on that, but you can check. And if you haven't placed, if you're the kind of trader is like, oh, I'm going to trade like once a month, then you will not benefit necessarily from that trader tax status. And I'm not a financial advisor or CPA. I'm just saying you have to be aware like of the benefits tax wise as well of what you're doing. And even if it's just placing a $1 or one share trade on the day, it's better if you basically have a strategy to practice instead of just doing it for the hell of it. But at some point, when you have a real firm grasp on your strategy, then it's to move on. But I think what you need to do really to understand if like how well you're performing on that strategy and if there's more room is you need to look at the other two stats that I mentioned, MFE, MAE, and those are two terms that are very technical and you can get really into nitty gritty of it. But essentially, let's just think simply. I like to think simply. How much does it go against me when I enter the trade, and how much does it go after I exit the trade? And as long as there are those parameters that are not being fulfilled, then you have not mastered that strategy. And some people will say, oh, you cannot always pick exactly the top and exactly the bottom. I agree, you cannot pick exactly both, but you can, a lot of times you can actually pick one of them. And there's been plenty of times where I'm literally the dead bottom of trade. So unless people who say that are basically limiting themselves, and there are ways to think of it where you can actually optimize to that point. And that's at the point where you can say, hey, there's not a lot I can do here. And then you can start saying, okay, now what is the stress to benefit ratio here? And you can say, look, you say, Brian, I have kids or I have a part-time job, whatever it is. I can only trade the first 4 hours of the market. Well, can you get it so that in that first 4 hours of the market, you exactly nail that trade to the as best as you can? And if you can get to that point, that's what you should strive for. If you're at the point where there's always extra meat for you, dude, you have a long way to go. Let's keep practicing. Let's keep going better. And you could say, hey, look, maybe I only have 4 hours, but things tend to fade way more than the time I've allotted. Why don't we just put like a stop order or something like that, like a range limit, range order or some trailing stop, or just have some kind of indicator that can tell you like, hey, just you have a moment to look at your phone. Okay, it broke the trend. Let's just get out. Things like that. You can do a lot of things. How do you track market cycles? Less gappers, less volume. Usually, you just break it down to is it bearish or bullish, and you can tell by the fact that like trades that normally would fade are explosive, or trades that normally are explosive will fade, like such as a low float. Like say you see multiple low floats popping up and you're like, oh, I'm just gonna avoid it because these things always run, and especially with everyone. Well, when those things are failing, then that the bulls are not really present to put on that risk, because if in the right conditions that would be a powder keg, and that would create a massive bullish momentum. So it does tell you a little bit about what's going on. And of course, like the amount of gap reserves is a correlation as well, but that's not always a bad thing. That's the thing. It can be a good thing for less, and for both strategies even. Like for example, if you're a long bias trader and there's less items to focus on, then you basically concentrated like a magnifying glass all of the focus and all the power onto this one area. And so now you have like a super amount of force in that one concentrated area. And vice versa, you could have a super weak market where there's not much, and people are just like, screw it, I'm gonna take the day off, or I don't want to do this. So then they will just trickle off and fade off real nice. So it is both. You just want to be present to understand like what is actually happening within the price action, and even if your system can produce signals, then a lot of times you can actually see, let's say in some senses that I like to call it divergence, which is you can see signals firing off that are generally valid, but because it's so bullish or it's being manipulated in a certain way, then those signals are not working. And so you can kind of see like either there's more force than you expect, or, and this happens a lot actually, or people are just chasing their ass off, and you can sense that. And this comes with just maturity over time, just seeing more with your system. This is the benefit of systematically approaching the market over time. You can notice things like this. How do you calculate and set your R size percentage of equity? I like percentage of equity. I don't really use Kelly. I heard of it, but it's not something I really delve into too deeply, because I think the percentage equity is just a very elegant solution and very simple, and it works. Like it really does work. Do you adapt signals per market cycle, like a bullish market signals are more passive versus bearish market signals more aggressive? I don't, but that's to my detriment. I think you definitely could be like an omni kind of very dynamic person who can take both sides when the opportunity presents. But I cannot like take my blinders off just because I'm so biased, and for that reason, it's very hard for me to chase or to be involved when I know like it's not a legitimate move. But the thing is, market legitimate or not doesn't matter. You're here to make money, so it's something that I definitely wanted to learn. But I think for most people, it would serve you better to focus on one aspect so that you can become a master instead of a jack of all trades. So usually, mastery is what gets you there. Like, just to kind of harken back to the last video that I posted in my review, because my losses, I can keep them small, like just a matter of 3 or 4 days can make up my best or my second best month. And that is the power of keeping your losses small and having mastery, because you can literally flounder around all month long, and if the market is correct for you and you understand exactly what you're doing, then you nail it. Versus you show up every single day and you nail every day, but then sometimes, just sometimes, you lose your ass, or you take the wrong bias and you get confused with yourself and you cannot really analyze it because maybe you're emotional, or maybe there's just too many inputs into your system that's just so overwhelming to analyze. For me, I know exactly like, oh, why did I screw up? Because I typically would enter here, I typically would exit here, or I typically would manage risk a little bit better. So I just know exactly what to bring in the next day. Versus for longing, I chose this random risk level, and I wasn't confident, so I put in half size first, and then I tried to add in to get more risk reward, but I bought the top and then it dumped, and I should have been short there, but I was long instead. And there's like just so many reasons why that will not work for most people. So just be really careful about that. It's something that you're gonna have to get over, but at the stages that most people are at in trading, I would assume it's not necessarily bad, because if you can like really dedicate to that time and focus on, hey, let's review our trades for the week. It's Friday, we got Saturday, Sunday. What worked for me, what did not work for me? Because largely in that second year of trading is where you kind of know what you're doing, but you're so scattered that you have so many mixed results. Now's the time to pick like the one or two things that you feel good about. And if you can recognize that, that's a big advantage. And just like ADF pointed out today as well, if you lose 70% of the time doing one thing, then why not do the opposite? You've actually figured out the edge in the opposite direction. Now it's the time to focus on that consistency. When you're trying to maximize your risk reward, are you adding more size with tighter stop or keeping the same size and trying to hold longer? I usually add and tighten the stop. That's usually the way to get more risk reward. You're going to lose more because a lot of times it will rip and you have to stop out and you don't have the opportunity necessarily to get the better prices. And or you're fearful and that can mess with people's execution. So you have to use that as something to work towards, not something to implement right away. It's something that you definitely want to figure out later on, but you need to be able to be profitable without adding relentlessly, because that is going to kill you. And the one thing I like to say is, if your win rate sucks and you start adding, it's only going to get worse from there. It's only going to go downhill. You have to pick a system that will have a good result at the baseline. So that, let's say, you have a 60% win rate. You start adding. Now it goes to 50%. You try to add a little more to 40%. That's a better position to be than you have a 40% win rate and you're trying to add 30%, 20% now. I see it all the time, because the confusion a lot of people have is I get DMs and they're like, Brian, oh man, I got like a 15R trade here. I'm like, dude, 15R, that is not like really sustainable. If you go for 15R is an immaculate return. It's nearly, almost impossible in the sense that, like, if you're putting that kind of return, the win rate has to be like very low, or you're doing something completely wrong. Like it's a red flag, and it's not something that I like congratulate. I'm not like, yo, nice one, because I know something is wrong about that. The usual like kind of peak performance stats are not that high, and so if you can literally maintain like a 3-to-1, 60%, like 4-to-1, 50%, you're probably better off than someone with like a 6-to-1 and 25%. Like, do not overcomplicate what it takes to be profitable, and don't look at someone like crazy like me who's like, I'm trying to push it to the exact limit, and I'm taking I'm taking a sacrifice, and I'm conscious of that. You don't need to go to that length. Like, I'm discovering it for you. I'll probably tell you at some point. I'll be like, hey, I wasted a lot of time on this, because really I could have just done what I did maybe in November 2020, and that would have been way more profitable in the end. That could happen. That probably is going to happen. So just keep that in mind when you're like trying to go crazy. Let's just go for that 3-to-1, or even easier, let's go for that 2-to-1. Get that nice win rate. See how that works on the equity curve sim. If you're longing, even better. You have no fees, you can go for that. And let's just focus on being profitable first. It's not about, there's no the game is not about like how big you can get your R. It's a myth, and I can tell you more than anybody, I'll admit it to you, like, it is not the best way to go. And a lot of times I get really frustrated when I'm like, oh, I just lost in this trade and it's meant to work, but my wrist is still tight, and that's frustrating. And I oftentimes think to myself, wow, I wish I knew what it would. I wish I was taking on less stress, especially as I'm getting older. I want less stress, so that would kind of push me in the opposite direction of like, let's be more conservative. Let's go for like something, lower R, higher win rate. It's not all that. It is not all that. Okay, if you started trading with $4,000, what would your max position be? I would just take 1% of that. $4,000 is not a lot of money. I just want to say, if you're starting with a small account, it's pretty hard, but at the very least, you can break it down to smaller pieces. I would probably even, if you're very, very new, I would even use less than 1%. If let's say you know how to trade, you blew your account up, maybe even go 2% on that, because you might need to put in more risk at a smaller level so that you can get to the point where you can start risking less because you built your bankroll. Um, you have to have positions that are sizable enough when you're in the building phase of your account that you can actually build bankroll versus like, if you trade a small size, a lot of times you won't overcome the fees necessarily. So you're just trading to learn at that point. You're just wading in the water. It depends on what stage you're at, but I would say it's not necessarily enough. But that's what I would do. And the thing is, the caveat is once you've built your bankroll a little bit, you're gonna get addicted to the feeling of that 2%. And this is the problem. It's not really sustainable. It's very difficult to actually trade with that much risk because you now cut your 100 plus chances of losing that 1R to 50. You cut it in half. The maturity that you need to develop is once you hit a certain point. Like, let's say you get that 4,000, let's say 10,000. Let's just start using 1%, man. You want to give yourself as much opportunity, but the thing is, people are going to see the money and they're going to see the gains. They're not going to be used to the slow rate of growth. And it's just a very destructive kind of thing. So I'll be really very careful. And I wish I could kind of like imbue you with my emotion and my experience in that. Because I know, like, even if I tell you, hey, that's going to blow you up, that blew me up, that's a real big problem. And you need to get over that. Until you've felt that yourself, it's actually gonna be really hard for you to like have the emotional force behind like my words and to take it to heart. But ideally you do. And like, look, if I have any hope for anything, the person that I taught never had any blow up. And so it's not a prerequisite for greatness to blow your account up or to have a big ass loss. We have enough information these days, or there's people like me who are sharing their experience with you, so that you don't have to put yourself in that compromised position. And hopefully you can take that to heart and that you can learn from that and not have to deal with that. But I'm just telling you that's exactly how you would get in trouble. How do you develop a healthy balance in life? I have no idea. It requires obsession to get up the learning curve in trading, but is it sustainable? In the beginning, in my opinion, you need to burn the midnight oil. You need to actually put in like as much time as possible. It's something that you have to really dedicate yourself to obsessive level. And that's the only way you really, I mean, it's not the only way, but it's the most efficient way to getting what you want, to the point where, these days, like if I wanted to, I could completely not review, not check anything, not take screenshots, not do anything. I would know how to trade. I could even take like a couple months off or whatever. I can come back next year. But in the beginning, you absolutely, in my opinion, need to put in that work. And so, for whatever, for sustainability's sake, if you want something better in your life, if you want like financial confidence and freedom, not freedom necessarily, but confidence is a better word. You are gonna want to put in all that effort. That's something I would definitely recommend. Later in life, you'll have to figure it out. That's a whole nother question. That's like the holy grail question. How do you differentiate between chat room momentum versus an algo? Because you can literally see it, and you really only have to follow a handful of guys, or look at a handful of chat rooms to see like, look, there's like tens, if not hundreds of thousands of people paying attention to this person. So chances are, you put them all together and they're going to equal one big boy. In terms of algo, you can see it in the price action actually. When things are so unbelievably unnatural, in the sense that you see massive flushes, massive spiking up, halting up, like literally 1 minute just undoes the whole move, or you see not, I don't want to like confuse you and say that it's in the tape because I can't explain it exactly, but it is something you can observe within the price action, in the sense that like the sharpness of the moves and how unbelievably aggressive they are is going to lead you to see algos. And a lot of times, like, the main thing is like, look, they accumulate stocks and then they wash them out, and then like you think they're dead because everyone thinks they're dead, but it's the you gonna learn today setup. ADF posted. You freaking think it's dead, and then it will literally take just a flip of the switch where now everyone's underwater. And a lot of times when I see that kind of action, I'm like, well, on one hand, it could be dead, but on the other hand, I wouldn't be surprised if I got stopped out and slipped and halted. And that's how you kind of know, like, it's just more than the chat room. And usually those happens over the course of like a long day. It's not just the open, because the open there's so much volatility and things like that. It's different if things are halting at the open versus like this is an hour, 2 hours, 3 hours in, or even the end of the day. It's different. When gauging market environment, can you go pure bottoms up? For example, just ignore all market indexes, etc., and just take trades when there's a proliferation of your type of setup and they're falling through. Yeah, I mean, like a lot of times, like I don't know exactly how you meant it, but in small caps at least, it's not 100% correlated with the market in general. So a lot of the setups are primarily technical with a little bit of fundamental, and often and sometimes very fundamental, but not often these days. So as in my opinion, as long as there's a technical setup, it's worth it to take the trade as long as you put on the correct amount of risk. And I never really overcommit. Okay. A low win rate requires larger absolute wins. How do you hold on to winners without exiting prematurely? You have to you have to really understand the risk reward concept and use systematic targets, like Matthew said. If you understand, like, one thing about the equity curve sims I really like is you can see a projection over time, so you know, like, you're gonna go in the right direction provided you trade up to a certain standard. Because of that, it gives me confidence to execute correctly because I know, like, where I'm headed. It's like I know that the steps that I'm taking will get me where I want to be. Whereas if you mess with that, you have no idea where you're headed, and it's a very, cryptic kind of path forward. But the simpler answer is systematic target. So I like to point out different ways for different people because everyone thinks differently. Everyone sees different patterns. Aside from, let's say, indicators, which can be really, difficult to understand and backtest, we can say technical patterns. Let's look for double bottoms. Let's look for double tops. Let's look for trend breaks. You can draw a line. You can just use a moving average as your stop. You can trail them. You can use the time itself. You can say, literally at this time of day, there tends to be this sort of move. And you could say, look, I mean, we've seen this all over. Let's just take the most obvious elephant in the room is MIC, right? They say to themselves, look, 10:30, a lot of times I'm getting screwed up. I'm just going to exit the position. Now, I don't agree with that because I have my own statistics and my own kind of observations, and I have my own bias. But it's not incorrect for anybody to have that sort of methodology. You can use that to your advantage. Just literally time, because at least in the markets we trade, time is a factor that is significant. For example, at the open, the most volatile time of the day. So I have people say, hey, look, Brian, I trade usually the first hour or two, and I just leave. And I'm like, that's great but he says, but I wonder if I should stay throughout the day because I'm wondering if I'm missing opportunities. Well, you're probably not, because most opportunities are happening within the morning range. because that's when there's the most imbalances and the most emotions, and that's what you're trying to take advantage of. So you're actually not really missing much. Um, but it's in terms of like targets and stuff like that, you know, momentum tends to dry up at certain periods of time, or people start giving up at certain periods of time. Even just think about the psychology of like, hey, does somebody want to swing this position on the, like, does your opponent want to swing this position over the weekend? Does, let's say the most obvious example, it's like VRPX, right? That stock, the day one, all day holding, and it's closing strong. Now, any short with any senses of risk management is going to cut that position at the end of the day or in after hours, like very swiftly, because they know that the risk is so much greater than the reward. And the only reason someone would be holding that is if they're completely emotional, or their size doesn't mean anything to them and they can just bully their way out of it because they have a huge bankroll. We see it all the time when there are stocks that are in the current market environment that close strongly and have these 8 after hours ripping. People are going to be sensitive to that on other setups, and the same goes for the vice versa for longs who exit their positions towards the end of the day because they don't feel comfortable anymore. They literally gave it all they could, and a lot of times they're back holding those because longs have almost a different paradigm in a sense. Like there's a lot of diamond hands activity, or there's like, it's not a loss until I sell, and so those people may not give you the same result, but definitely shorts being coerced into covering and compounding on each other. Hey, I cover. Oh, that triggers your stop. You cover. Oh, that's too high. Cover, cover, cover. Oh, I'm gonna buy that too. I'm a long trader. I'm gonna swing it overnight. And there's just all these players involved. So time plays a factor. You don't want to overstay your welcome. A lot of times, like, you can definitely literally just use that, and that can be completely statistical. Using statistics, I mean, you can literally just write it down in Excel. Hey, okay, to set up this time, this time, this time. You can average it out so you know exactly like when the average time things start to get kind of crazy. And there you go. That's the system. That it doesn't have to be black magic. Must be frustrating if it barely misses your target and retraces. This is where you need to have the concept of good enough. So for me, a lot of times when I have my target and it starts bouncing off that level, I will consider that potentially a breach of trend, or like, because my price targets are so optimized, I know like it should either hit or it's probably going to reverse. And so if I start seeing signs of reversing, you have to tell yourself, like, is it worth me holding it for that extra penny or the extra 10 cents or whatever it is? A lot of times the answer is no. And so that's where I just get out. That's how you capture most of your move. And you have to kind of develop that over time and figure out, like, hey, this works for me. But you cannot just let things completely retrace in your face all the time, especially when it's within striking distance of your price target. That's why it's your price target, and you're not Houdini. You don't know exactly it's going to hit that price. Do you use hard stops or mental stops? What do you feel about OCO or range orders once you've entered the position based on your R? Okay, I use hard stops. I used to use mental stops, but I think the idea of a mental stop is something that leaves something to be desired, in the sense that your control is still based on how level-headed you are. Whereas a hard stop, it will trigger no matter how you feel. And even then, sometimes hard stops don't even. Sometimes your stop gets skipped over, and you will have to react. But I like the fact that it initiates the process. Like, it's much easier to exit a position once like your hard stop kind of like gets you out of some of your position. Because for me, I'm kind of like a perfectionist. Like, I want to be on my 100% position, or I want to have a clean slate. And so I'm always If I get a little bit out, I'm like, I'm gonna just get it all out. Um, the thing is, it works majority of the time as well. You're gonna get slipped, yeah, occasionally, but I think it's a really good habit to form. It it's in line with everything that I think is important, risk management, and it's systematic so that you can put that stop while you're sane and you're thinking clearly versus in the moment that it hits your area and you're like, oh, is it time to stop or do I wait? And that can lead you to some of the worst kind of typical emotions that you're going to face, which is wanting to have revenge trading or not wanting to stop out and see what happens. And that is how that's how traders fail majority of the time. It's usually not anything dramatic. It's basically letting your stops go and going crazy. With OCO and range orders it can be good. I like it, especially if you have your price target and you have exit. It's perfect. One thing I'll say is it doesn't mean like it doesn't equal like a perfect scenario for you. You have to still eyeball those trades around those areas. So a lot of times, like what I don't use range orders in particular, but I don't think it's bad. If I had a stop loss and I had a limit order waiting to fill my prices, I would put an alert there if I'm going to walk away, like right below or above both of those prices, because you still need to manage it at the time. Because at times it won't hit exactly, or something can go wrong, and that's something that you need to be really cognizant of. So that's the one warning with it that I'll give you. Do you do range orders for risk, hard stops, and 2 or 3 hour profit taking? No, I don't. I don't take it at specific R's. I won't just take it arbitrarily. I use I just put a hard stop out and I use a limit for my covers, and that's basically the same thing as range order. The only difference is that I can use limit instead of market, and I prefer that because I don't appreciate getting filled at weird prices with market orders. So if I'm gonna get slipped, I'm gonna do it by my own hand. That's the way I see it, and I generally have more consistency in keeping the numbers correct without using market orders. And at a point like with you, when your size is big enough, like you don't necessarily want to market order because you can really push the price. And for hotkeys, just I have very simple hotkey setup where I can set my stop, but at the same time, it's too like I can't. It's too. It would be better if I had the visual representation, but which I don't have right now, so I can't really show you exactly. Do you borrow enough shares for more than 1 hour in anticipation of setting up for a larger turn, or will you vary based on setup grade? That's definitely based on the setup grade. So like, some people will put on more risk on a trade that they really understand, or that's like an A plus, and that's a situation, but I won't just do it for like any trade. Is ADF your bread and butter? Yeah, I mean, I like those setups, but you don't see them that often lately. So it's it's definitely been hard. Did I trade GovX today? Yeah. I definitely trade like, I would say the way I trade right now is like mostly technical. If I had to put it in one way, it's like I'm trading just supply and demand, and it sounds really like, I don't know, sounds really basic, but that's what it is. Like if you see things getting pumped, like that is artificial demand. So at some point supply kicks in, and if you're wrong, you just manage the risk. That's the way I see it. But if I'm right, I'm just trying to revert it to the mean reversion. That's more applicable to the way I think today than like back then. Because an ADF assumes like everything is going to get sold into. There's a lot of dilution, and there's not much of demand. It's a very straightforward setup. whereas mean reversion can have any sorts of volatility, and the goal is basically to just bring it back to earth. That's all we want. Is it alright if I drop in a trade risk calculator spreadsheet and modeled off you released a while ago? Yeah, you can. I don't know. I don't know if. I mean, this was like 20 minutes ago, so I don't know if you're still here. When you reach a price target, how do you like keep running trailing stop profit? No, I don't. Wait for signal exit. Usually, take off the trade once it's reached price target. Usually, I take it off the price target because you know, usually I mean I optimize my process. Like this takes a long time where I just seen it enough. Like I've analyzed enough trades where I'm like, okay, it always goes further than I want. It always goes, you know, it always goes like 30 minutes after I exit generally, or I just need to let it test that low again generally. Like things like this. So I know where my like optimal target is, but that's where it generally starts. Like it's not about that one trade. It's not about the trade ahead of you. It's about the work you do post, where you can come in with a new optimized methodology the next time, and that's where you see the result. Not because you just let one trade start working. Because the thing is, if you don't understand or have a concept of why it kept running, or you just got lucky, or even if you got unlucky, I mean, what do you learn from that? It's all about the aggregate. Do you think trading indicator free is doable? Yeah, for sure. You just, you know, like a technical pattern. I like it might be kind of. I don't think it's controversial, but like I would treat a technical pattern similar as an indicator, because the goal is basically to generate a signal, right? So whether you're drawing some kind of wedge or something for yourself, it's the same thing, because you're coming to a point where you decide to take the trade, and that can, you know, whether or not you're drawing it, you can be observing it, like let's say a double top, for example, or a triple top, something that's just much higher odds, or like a head and shoulders pattern. You know, you don't need any indicator for this. You have you see a high, which is the head, and then it creates a lower high, and that, you know, if you want to place your risking above that high or there, you know, that's a very simple indicator free type of trading where you can get an entry signal. The thing I think that most people struggle with is not that they don't know how to enter trades. I think a lot of traders actually do enter trades pretty well, because that's the first thing you focus on. Actually, like when I get DMs, I see a lot of people who have great entries. The universal aspect that people screw up with is the exit. They always exit very closely to their entry within minutes, or they don't know how to take it all the way. And that's where like using an exit signal is more beneficial than actually the entry, because the exit determines how much reward is available. It determines how you manage the trade. It determines where you can place your stop. It determines if the trade is worth taking, in the sense that there's enough meat on the bone for you. And it also helps you optimize the meat of the move. That's where the focus should be, generally speaking. Okay, yeah, I have a YouTube channel, Lydia. Nice, we got to the bottom. So let's see. Can you talk about the tool used for systematic trading? Do you have custom codes or legend? I just use Thinkorswim for charting. I think you can use TradingView as well. They both basically have very similar functionality, and I think, you know, a lot of indicators being shared between the two. So there's a big reference there where you can kind of code your own, or you can, you know, you can find codes online. And again, when it comes to codes, I don't do anything crazy. You don't need some very type of indicator. The best types are like very average, like a moving average. Let's look at a great trader, Maggie, who's coming in on like the 100 million mark. I don't know if he crossed it or not. It's just moving averages. I mean, moving averages, you guys. It can be that simple, and those are some of the most effective indicators there are. You can just put them on every single time frame, put them on the daily chart, put them on the intraday, put them on, like moving averages is basically, you don't need any custom code for this. You just plug it in. It's already in the thing. For brokers, like Centerpoint's pretty good. They're expensive, so if you're new, you're gonna get fleeced. And if you, uh, I know they're doing smaller accounts now. If you do their account, the small commission is gonna kill you, I think. And then the other ones like Trade Zero, they have uh, good availability, commission free. It's better if you're gonna trade like a lot of size. I think it's good for international. The locates can be really expensive though from time to time, and there's Cobra. It's cheaper overall. I mean, there's plus and minus to that. I haven't used it, so there's a couple of shorting brokers like that. I honestly haven't really I kind of just consolidated most of it into like one or two brokers. I'm not trying, like, as long as I have a good relationship with them, it's more important than like how many I have. And I think it's kind of difficult to manage multiple accounts. For me, it wasn't good. If Scanner, I use Trade Ideas, and I think they're really good because there's a lot of customization you can do with your filters. And I like, I think it's important to have real time market information so you can act on quickly, which is exactly what they're giving me. So to me, it's a no brainer. But like, of course, there are like free ones as well if your strategy doesn't need you to be as quick. Or you can basically just use social arbitrage. Really, you can just go on Twitter and look at what's hot. That's also pretty easy. You can use chat rooms as well. You just like look at what they're doing. There's a lot of ways to like find trading ideas. The main thing you're looking for is volume, range, and volatility, and all those things combined will give you a setup in one form or another. What traders do you look up to? ADF. I mean, there's a lot. I don't know like how to list them all because I'm gonna forget. But I think ADF is really, basically everything that I say is kind of he's influenced almost all my thoughts in some way. And I think as far as somebody on the online who's like pointing people in the right direction, I think he's definitely that person. And he's been very generous as of late. So a lot of, I think he mentioned like, oh, my friends, they don't like when I'm sharing this information. And I almost felt the same way for other people as well, where I'm like, wow, they're sharing this information, it's going to make life harder. Or why is he doing it? But he is a very generous guy, so that's something to take advantage of. Not everyone I look up to even posts. Like sometimes they just go rogue, so it wouldn't even really benefit you that much. And also, I'm sure you can guess, it's pretty much like everyone look up to everybody. Everyone's like pretty much have the same kind of people they look up to. I don't even know how to say that another way. Do I use broker max loss? Yes, for sure. How? You just need the right broker. All the brokers I mentioned have the functionality. The retail traders brokers won't have it. Like, I mean, we're all retail, but I mean like Thinkorswim and stuff like that is not going to work. Okay. So I think I am gonna wrap it up pretty soon. I'm just gonna get through the last ones here. How much room do you give low floats when you scale in? So with a low float, you always have to execute on point. Like you need to risk the best level. So the risk I give it is not something concrete. It's based on how far my average is from the best risk level. And so that can be something from the daily chart. It can be from the intraday, like, the highs. but you certainly cannot risk like random levels on low float, because if you do, it's more than likely gonna wick you out of the trade, and that happens very, very often. So it's a fully executional based kind of strategy when you deal with low floats, and it's something that you don't have to trade, and it's something that a lot of good traders and great traders avoid purposefully for that reason. And specifically because as you scale higher, it can be harder to manage the risk. You can take fat losses out of nowhere. You can get halted over your stops. You can be upside down within, let's say, 1 minute after being right for hours. And so that's something to consider when attempting it. And for as much hype as there is around low float, like just that verbiage, it's overrated completely. And the only reason why people tend to trade low floats is because of the volatility, and that it's easier for people to manipulate. Like pumpers love low floats because it's not hard for them to say, hey, look, it's pre-market, let's buy this crap up and it'll go up like 100%. And on the flip side, low floats tend to be a little shadier in terms of their share structure. And so that can attract short sellers as well. Depending, like sometimes serial offenders will like reverse split. And so people know there's like a significant risk. Like there aren't many stocks that are low float that are actually good companies. You know what I mean? Like generally, that's not how it works. So that's important. Which moving averages do you think are the best for intraday trading? I like longer ones. So I like 50, 100, 200, and 20 is good. You have to play with them on different time frames. Some people use like smaller ones like EMAs, like really close to price, and I tried sometimes, but it's not really doesn't really work that well for me because it's kind of inconsistent, or like it's too noisy. So if you just think about it, like when you first start trading, like what are the ones you look at? 100, 200, super normalized, and you can definitely like anticipate that other people are going to care about it, versus you have some 4 minute chart, 7 EMA that nobody gives a shit about. The good thing about moving averages that are a little bit like wider is that on multiple time frames they kind of have like what is the word? I'm trying to look for it. I'm thinking of convergence, but that's not the word. Confluence, I think, is when the indicator you're using fires on several time frames at the same time. That's the power of the ones that are the most common versus something that you just pull out of your ass. Do you ever long the Yukon Learn setup? No, I'm usually getting shit on the other side. For my max loss, it's based on a number of factors, but basically, if I had to sum it up very simply, your average risk reward per your setup. And since I trade very similar setups generally, I know that I typically trade, let's say, 2 to 4 tickers a day on just a normal day. So if I expect to make 3R generally, right? I'm throwing stats out there. Then I probably want to lose twice per ticker so that I'm profitable if they work. So let's say 4 times 2 is 8, so minus 8R in the day, and minus 2R per ticker, knowing that I'm going to aim for 3R. Because if you have a 3R expectancy and you risk 3R per trade, then you probably need to work on your system so that you can actually, not take so many losses consecutively. And that will help you in the long run. But also, even if you break even, you're gonna be red on fees, and generally that's not good. You want to kind of like put yourself in a position where you're generally coming out green. I mean, which means your 1R overflow eats all the fees and all the previous losses. If you constantly hit your max loss, you need to analyze like what is what can I do to prevent those initial losses so that I have a later signal, or I'm trading more conservatively, or I am using starter positions and like that. You don't always have to take an R in every trade. You can cut your losses prematurely if you think they're wrong. You can put on starter sizes, and when you cut them, it's going to be not a big loss. So it basically, as long as it adds up cumulatively to that 2R, then you're usually going to be fine in that sense. Yeah, I'm going to post a recording on YouTube, Chris. How low is low flow? Like, yeah, less than 5 is pretty low, like maybe 4. I'm a pretty extreme person, so like for me 2 is like mega low float. Okay, no, I'm not going to answer any more questions on these ones. Sharp says, when thinking about increasing R for traders just reaching consistency, how would you recommend increasing your R if you're not comfortable increasing with your account size? Only ideas had to increase R 3 to 5% if I had a profitable week and a big risk. You definitely need to go ahead and like look at my resources and my link tree, like specifically the blogs are really important for compounding, and even the R compounding video I use on YouTube is really good. Like in that video, I'm not even using 1% of my account because of PDT. So I've like taken my account, subtracted PDT, and I'm risking what I have over PDT. So in your sense, if you have a number that you want to keep consistent at, you can subtract that from your account so it's not of a risk, and compound off of the dollars that you're willing to risk. Like let's say you have $10,000, right? And you're willing only, like for you, your risk of ruin, this is an important concept. Like for you, if you lost $5,000, you would be pissed, right? So let's just use $5,000 as your compound and leave the other 5K alone. So you can treat your 10K account as a 5K account, and that way you'll be able to grow while being comfortable, because you know like you're not going to kill yourself and you're not putting on too much risk that you know more than you can handle. Do you use 90 MA VWAP cross? No, I don't really pay attention to that kind of thing. And I think, yeah, the last one was just smile, so I'm going to cut off at Chris. Will you stick with full risk or trail stop if say 2/3 away to your target and pricing can't keep going in your direction? That one I'm still working on, but like I would say for the vast majority of your journey, you can just hey, stop our target, that's it. Because the problem is a lot of times people psych themselves out of positions, and you're gonna never be able to realize your potential if you've never 100% realized your trading plan. And at the point where you can at the point you can consistently execute your plan to a T, meaning you cut at your risk and you take profits at or near your profit target. And I'm not talking like premature, I'm talking just, good enough levels, like it's a couple cents above or something like that. That's when you can start making decisions, because you've probably given yourself enough time to understand all the nuances about the trading. And so for that reason, I never recommend people play any fancy games, because again, literally the worst thing you can do is cut your trade out of emotion. And then, well, it's not the worst thing you do, but I'm being, I don't even have to explain that. I just always kind of embellish things just to, say a point. But I mean, like, you will literally deal with so much emotional turmoil by the fact that you've cut a trade that would work. The only way around this is to create plans that work consistently so that you can analyze them in post. Again, it's not about the one trade ahead of you. It is about what you've gathered from that trade and many other trades like it, and the work you do outside the market. 90% of the work, in my opinion, is done outside the market in terms of your profitability. how you position size, what is your system, what is your, you know, have I analyzed like how far these trades are going against me, or how far are they going in my favor after I've exited my trades? Can I optimize the way that I'm trading anyway? All of that is in post. You you fabricate a new thesis or a new idea of how to trade. You bring it to the market the next day. It works. That's perfect. You just grew. It doesn't work. Oh, that sucks. You just go back. Either case, you need to give it enough kind of sample size so that it wasn't a fluke. Like you need to give it enough time and enough attention so that you develop a sense for if this is a true result or not. Because you can get extremely lucky, like I did in my last video, where you have a great month and it's something that doesn't work in a month that is not favorable for you. It literally was just perfect timing. Like it worked right then and there because I optimized it for that moment. If I trade that way for the rest of the year, it would not be good. And I learned that by giving myself 1, 2, 3 months of actually seeing it. And the only reason I gave it so much time was because it worked so well. Generally speaking, if I know something worked for like a week or two, doesn't work for a month, I would be like, yeah, that's it. Like I don't need to think about it. But because it was my best month ever, I had to hold on to hope in the sense that this, the market was not the same. I need to see this different market cycles. I know the potential. I know the reward output. So that's all another ball game. But essentially, you will figure out exactly what you need to do by basically journaling really intensely every single day. And that it doesn't have to be like, some people will disagree, but I don't think it's like, oh, I felt like this way today. I felt like my toast was burnt this morning. Like you don't have to say all that stuff. You can just say, okay, here's my trade executions. I screenshotted my chart. Here are the executions from my broker. Did I stick to my plan? I lost an R here. Oh, I got slipped here. Oh, I followed my plan here. Oh, I didn't follow my plan here. Oh, I followed my plan here, but it went on for another 10 minutes. Okay, next time we trade the setup, let's literally wait 10 minutes, or let's wait until 10:30 or something like this. Or let's say like, oh, this signal that I've been using, let me go back test it now on like a month. Let's go back test it on 2 months. Quite frequently in my career earlier on, I would go back 2-3 months just to see if, how consistent my signals would be, and if if they gave me a good result. And so I go back and I'm like, oh yeah, over time, like generally speaking, it gives me a pretty good safe result. And for that reason, yeah, okay, it didn't give me the best result today. Like, yeah, it went faded more than I wanted, but like, how often does that happen? How often is there a situation where it goes way further than you think? Like most of the times what happens is it hits that price and it reverses, and if you think that because I optimized for that mega fade, that's what you're going to get every time, then a lot of times you're going to get reversed on and it's going to suck. So you have to kind of understand, like by filtering out what we can consider outlier situations, and this is all by hand, by the way. This has nothing to do with statistics. Eventually you will build like the memory and the intuition and come to the market prepared, exactly knowing with confidence, like the tools that you built for yourself, or the mindset that you built for yourself to approach the market on that particular day. And then all you have to do is just kind of analyze, like, okay, how did that work for me today? And it's just a consistent repetition of this action of improvement where we compound our actions. And everyone should have probably been exposed to this idea, but just in case, the best 2 books that I recommend in trading are not trading books. Atomic Habits by James Clear. What are the small things you're doing every day? The systems that you're doing, not goals, but systems rather, to get what you want. Let's say, for example, there's a famous quote. He says, everybody wants to win. But just because you want to win and you tell yourself positive things doesn't mean you're going to get it. The thing that gets the result is actually what you're doing every single day. Like if you want to build your body, are you working out every day? Are you getting the protein that you need? Are you, getting the dietary amount of calories that you need every day to reach your fitness goals? Those are all systems that you're implementing every day. Not that you just want to have a hot body and you're going to work out. And then you have the second book that I pair so greatly with it is The Compound Effect by Darren Hardy. And this is a book that explains compounding in numerous situations. And compounding is something that's really important to me, but also in the macro sense that if you will increase your performance 1% every day over the course of a year, it's going to be significant. And so by having that kind of drilled into you between those two books and that mentality, you will understand why every single day doing this internal work with your statistics and with your just the simple execution of your system is what's going to lead you to have the greatest benefit in the long run. And it might not be sexy today, but over time you will not be recognizable, and you're gonna see exactly what you need to do. It's called The Compound Effect by Darren Hardy. So it's combining these two principles together to create like a super performance type of mindset and mentality. And it's not a fluffy mindset like I just say positive things all the time. It's understanding the work you do every single day is going to add up, believing that, and it's very much in line with the idea of what I'm telling you about the of the equity curve sim. If you can see or project yourself far into the future, knowing that the steps you're taking today will lead you to that point, then you're more likely to follow through with that action and also have the motivation to persist. Because in trading, a lot of traders can make it, but they can make a lot of money. They can make it really quick. But not many traders can get their ass handed to them day in and day out. Like literally my mentality every single day is that I'm going to get destroyed. I'm going to get slipped. I'm going to get halted on. I'm going to lose money and get back and keep trading and managing the risk. What happens, a lot of people, they get really frustrated and they start breaking all their rules, or they get so disheartened that they cannot continue. And I know exactly what it feels like to wake up in the morning and not be able to move my body because I'm so demotivated by all the pain. But you have to be able to push yourself through that and just get up anyway. And a lot of times what I have to do, it will be on YouTube, Jerry. A lot of times what I had to do was literally count down in my head as I'm getting up, as I'm feeling so tired, so defeated. 3, 2, 1. At 1, I would just jump out of bed and go. And there are things you have to do like this to just get yourself into a disciplined space whereby you can not only rely on your passion, but also on your systems to persist through these times. Because after you've gone through the learning, like the incredible learning curve of trading, it's something that pays off in an extraordinary way. It's extremely worth doing, but you have to kind of put yourself in the right position with your habits and everything every single day, and also finding the right information. And here's the thing: market tuition. A lot of people are going to come in market and learn from the very wrong person, and I did too. No, not many people are lucky to start with the right people. So you come in, you learn from the worst person ever, and basically you wasted all your time, and then you don't realize it until it's too late, because you're dealing with someone who's very charismatic, who has seemingly great reputation, has all these connections, whatever. But the thing is, there's so much bullshit, and the only way you're going to experience that is either someone points it out to you, or you've experienced it and you just figure out like, this sucks. Because I bought all these kinds of products, I joined all these kind of rooms, and I'm like, I had 100% belief in that moment when I was doing it. Thing is, I didn't have the ability. That's exactly Mel Robbins, Chris. You're right. The thing that you don't have is like at the beginning is the sensibility to question. Some people do, but I didn't, and I think most people don't. Where you're like, can I test this? And what I aim to give every single person here is not like, as you know, like I don't share exactly like how to trade a strategy, but I'm here to show you how you can doubt, test, question, and be skeptical of, but not only that, prove, not just be a cynic, but prove if you're learning from the right sources so that you can kind of narrow that down and figure out exactly how to get on your way to being profitable as an individual. Um, and that's a very important skill in this game because there's a lot of bullshit. And a lot of times you're never going to realize that until you make it on the other side, because there's nothing more sexy than a huge P&L, and people know this. And the thing is, you have you have to understand what were the mechanics of how they got to that point. And it's just, I'm not the kind of person, or at least I don't want to be the kind of person to be a martyr or call it anything like that, but there's a completely so much bullshit online. And as at least if you understand a risk reward, learning setups with like systematic thinking, and also being able to track how these strategies will perform in the long run, along with the most important risk management, you'll be in the best position to find yourself as a trader, uh, and actually even more specifically with position sizing, so that you can go through all these idiots, all these bragging people, and come out the other side because at least you survived. Because a lot of the beginning is survival, and most times people fail because they do not survive long enough to learn from their mistakes, and that is just the reality. So that's basically the end of this recording. We went off for